Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, welcome to the new episode of Through the Noise. My name is Heung, Senior Investment Strategist in the CIO office. Today, I'm very happy to be joined by Raymond Cheng, our bank's Chief Investment Officer in North Asia. Welcome, Raymond. I think we have quite a bit to cover today, so let me just cut to the chase and shoot over my first question. So, global risk asset made new highs in the past week. How should investor position now?
Indeed, Ray. Global equities have scaled new record highs, but they're now running into a headwind. Now, this sentiment is felt in the stretch investor positioning in global equities, and it raises the risk of a near-term consolidation. Technical indicators, called fractals, measure the degree of one-sided investor positioning. And they have fallen below a key threshold of 1.25 for several asset classes, including global equities, developed market high-yield bonds, as well as emerging market local currency bonds. Like these extreme one-sided positions raise the risk of a short-term reversal in trend. As the US dollar bounces from three-year lows, these assets are likely to come under pressure. This coincides with a short-term bounce in the US dollar, which is negative for risk assets. Therefore, we would not recommend chasing the rally here. Instead, we would view as this opportunity to diversify out of US dollar assets. So we'll use any near-term volatility to reduce overexposure to US markets and rotate into our preferred assets. These preferred assets include China and Korea within Asia ex-Japan equities and emerging market Asia local currency bonds.
Thank you, Raymond. So in your view, what are the next important data points investor would need to pay attention to?
Yeah, we think that the market will likely take care from three important data points, namely US inflation data, ongoing trade negotiations, and Q2 corporate earnings. The first focus will likely be the US June inflation prints released on July 15th. A pickup in US inflation could be a trigger for equity market volatility as it would delay any Fed rate cuts, now expected to resume in September. So far, US inflation has defied expectations of a rise following the imposition of US tariffs in April. This has been partly because US businesses have built up sizable inventories by front-loading imports before the April tariffs came into effect. But inflation will likely rise as the inventories have been depleted, with the earliest signs likely coming from June's inflation print. The market expects the US core consumer inflation to have risen to 3% year-on-year in June from a four-year low of 2.8% in the prior 2 months. We expect any rebound in inflation to be short-lived, as slowing below-trend growth caused by trade and policy uncertainty will likely drag down service sector inflation, the largest component of the consumer inflation basket. US long-term market-based inflation expectations have remained within the year-to-date range. The second focus would be the ongoing trade negotiation. We view that any success with the US concluding trade deals should significantly lower the ongoing tariff uncertainty and cap any concerns about a sustained bout of inflation. This and proposed changes to US bank capital requirements to encourage banks to hold more government bonds, in turn, will likely cap US dollar bond yields. This week, President Trump pushed back a deadline for imposing stiff reciprocal tariffs on trade partners from July 9th to August 1st, giving more time to negotiate for trade deals. While these negotiations will likely cause market volatility, we expect major US allies to agree to a 10% base tariff, along with pledges to boost energy, agriculture, aircraft, and defense imports, as well as invest more in US manufacturing. We expect the US to reach broad trade framework agreements with the EU, India, South Korea, and Taiwan over the coming weeks, with Japan potentially reaching an agreement once the upper house election on July 20th is over. The third, but not the least, focus will likely be the Q2 earnings season. We believe that the bar is low enough now for US earnings to beat expectations after a significant downward revision in consensus Q2 earnings growth numbers to 5.8% year over year from 10.2% expected back in the beginning of this year.
Thanks again, Raymond. So on earnings, you said the bar is quite low for earnings to beat. And so what we shall be focusing on instead then?
Yeah, within the US equities, our preferred sectors are technology and communication that have been leading and should be expected to lead the earnings surprises in the second quarter, thanks to sustained strong revenue growth from AI investments. We'll focus on the company's forward guidance and how it's influenced by consumer strength tariffs and AI investments. It will be crucial to monitor the full year 2025 and 26 earnings growth expectations, currently set at 8.5% and 14% respectively. Now, we are also overweight the financial sector. For financials, we see 2.7% earnings growth in Q2 and 4.8% in full year 2025. Major banks should drive this earnings growth. We expect management to be upbeat on the US consumer, given robust employment with contained provisions for credit losses. Major banks already passed the Fed's annual stress test. Also, the proposed relaxation of the supplementary leverage ratio should also free up additional capital. While tariff uncertainty may dampen corporate loan demand, deregulation allows major banks to pursue other growth opportunities, raise dividend payout, as well as enhance stock buyback. The overall for the technology sector, consensus expects 17.7% earnings growth in Q2 and 16.9% in 2025. AI investments continue to drive growth for semiconductors, and sovereign AI demand should also offer upside. We also think that software spending would stay resilient, given C-suite mandates to use AI tools, while the more complex reasoning models should sustain cloud demand. The weak US dollar will also be supportive of earnings growth as the sector generates 55% of revenues from outside of the US markets. Now, of course, there would be some risks in the second half of the year with respect to tariff uncertainty and also the geopolitical landscape. Most tech companies have a tariff exemption, but the US Section 232 investigation into semiconductors is still ongoing, with clarity in the upcoming weeks or months. A potential tariff on chips manufactured outside the US could lead to cautious guidance and a sector pullback. We'll use this as an opportunity to add exposure, given chip makers have the pricing power to pass on higher costs, and global demand remains quite strong.
Let's maybe round it off with a discussion in the Asian equities. And earlier you said that investors shall use the expected volatility to rotate into China and Korea equities. But Asia is going to be impacted by the tariff headlines too. Is it correct?
Yeah, it's fair. I should say that, but do note that President Trump did extend the U.S. tariff deadline to August 1st and proposed a reciprocal tariff of 25% on both Japan and South Korea, in addition to 50% on Brazil. Now, meanwhile, U.S.-China tensions have calmed, with China's rare earth card keeping the U.S. at bay for now. Overall, the US tariff announcements are not overly alarming. For example, tariffs on both Korea and Japan remain largely unchanged versus the April levels. The US is threatening up to a 35% tariff on Japan, but the deadline extension provides some buffer time for negotiation. Now, this is important because Japan's upper house election on July 20th have made discussing politically sensitive topics such as automobile and rice exports more challenging. Now, we think valuations of Asia ex-Japan equities remain compelling after all, with the weak US dollar lowering import costs, supporting corporate earnings. Now, the region can benefit from rotational flow within EM equities, such as outflows from Brazilian equities. We favor markets such as China and Korea, which have strong domestic policy support, which should be able to boost corporate earnings growth projections.
Thank you, Raymond, again for the sharing. So, in summary, I think we shall encourage investors to use the upcoming volatility to reduce their overexposure in U.S. assets and move into equities in China and Korea. We will also recommend investors to use the rebound in the U.S. dollar strength to scale into EM local currency bonds. That's all the time we have for today. Thank you for listening and stay tuned for our next podcast. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.